Yes, guys, welcome to the next video in the core fundamental section. So what we're going to be looking at right now is asset classes. So now, many of you know, of course, about different types of asset classes, but the thing that you might not understand is how this actually affects Forex and currency pairs and USD and everything like that. Because at the end of the day, you've got to understand um, especially with investors around the world, they want to put their investments in something that will actually bring them the best yield. So whether that's in certain currencies, whether that's in certain commodities, whatever it may be, these are the correlations that we've got to understand. We've got to understand the flow of money and the flow of capital around the world and see how this affects each asset class in a way. So if we were to break it down, there's four main asset classes that we look at. There's fixed incomes, which are government initiatives. So what this means is treasury bonds, cash deposits, saving accounts, and corporate bonds. Then you've got the second asset class, which is equities and stocks. So what this is partial ownership of something. So this could be a common share, a preference share, emerging market equities, and there's obviously different types as well, but these are the main types. Then third, you've got commodities. So what this is owning tangible assets. Of course, you actually don't have to buy bars of gold, but you actually own that asset. So you've got precious metals like gold, silver, and obviously all the others. Then you've got oil, and then I've put it as others. We get more into this, in more detail, but you've got dairy, you've got lumber, and plenty of others that we're going to look at. And then lastly, currencies. This is obviously what we're most familiar with. There's certain types of currencies that are safe havens, especially in times of market crisis. People want to put their money into something that will be as safe as possible. So yeah, people will own, many different types of currencies, not just their own domestic currency. So what we look out for, we look at the bond market, the stock market, currency indexes, and the commodity market. And why do we do that? So I've just been briefly explaining that, but to put it all in perspective, to understand fundamentals, we must ensure that we know what is going on with the flow of money and investment around the world. At any one time, imagine that there is a set amount of investment, and the owners of this capital always aim to look for the best opportunity to both hedge their money against inflation, which is very, very, very important because you must understand if you hold just cash, inflation will eventually make your money devalue in perspective of the entire world and what's going on. Holding your money as cash will simply depreciate it as it loses purchasing power with rising inflation. As a result, as investments move from one asset class to another, this has a great effect in the interlinked market places. So you've got to understand that every asset class links together, but you must understand that link and how that affects our currency pairs that we're going to be trading. So how can we benefit from this knowledge? In understanding all of the inter-asset class movement of capital, we understand the effect of certain currencies, thus providing us with a more profound directional bias. There are usually clear correlations and inverse correlations between different asset classes that we will go through eventually. So the first type that I have to explain, because I'm pretty sure most people are not too familiar with the bond market, just understanding how influential this actually is on interest rates and what the Feds really look at. So bonds or fixed income investments are essentially loans from an investor to a company or the government. Bond investors receive periodic payments based on the interest rate at which the bond was sold. So basically, bonds are used to borrow money from investors. So the government or a company like a stock company, they might say, okay, we want to purchase some bonds. Then the investor essentially sells that bond to them, or not sells that bond to them, but essentially gives that company a loan or the government a loan. Then that loan is paid back to the investor in full and also with interest rate as well. So bonds are used by companies, states, sovereign governments, municipalities to finance projects and operations. So a bond is referred to as a fixed income instrument since bonds are traditionally paid a fixed interest rate, which is called the coupon or the coupon rate to debt holders. Variable or floating interest rates are now quite common. Bond prices are inversely correlated with interest rates, so when rates go up, bond prices fall and vice versa. This is something that we're going to go through briefly right now, but it's something that we really do look in detail, especially later on because you've got to think of it like this. You've got bonds, which is the actual asset. Then you've got the return on that bond. And the return of that bond also depends on interest rates at the times. And that affects the yield. So as the bond matures and over time there's a maturity date, that yield increases. So it might be a 2% yield, for example, or it might be 5%, however much it is. And lastly, bonds have maturity dates at which the principal amount must be paid back in full or risk default. So bonds can be risked as a default, so they don't have to pay it back fully. But usually with government bonds, this is very rare that happens because the government is such a big institution. Very rarely do you see this happen where a government will default. You see this more commonly with stock bonds. Obviously, what do they call it? The company bonds. That's it. They can risk default. So obviously, investors need to look for the best types of stock companies to deal with their bonds, because if they're investing in something that they see potential where the company might break down or can't pay that back, obviously you don't want to be investing there. So the types of bonds, like we've explained, you've got the corporate bonds, which are companies, municipal, which is states, government, which is US Treasury, which is the main types of bonds that we look at. And then agency bonds are government affiliated organizations. But the main ones, as I said, were the government bonds, the US Treasuries. Now next, the stock market. So stock prices move on expectations about the future as news conveys information related to the economy and the direction of future interest rates. As a leading economic indicator, the S&P 500 Composite Index, just before we get into that, the S&P 500 is pretty much 500 of the top companies in the US, and it's all bunched together in an index where where investors can put their money in and see returns on that. And the S&P 500 represents the market proxy. It's predictive of a recession or an economic recovery. The S&P 500 index captures stock movements along with the widely known but less important Dow Jones Industrials and the Nasdaq Composite Index. So the S&P 500 is pretty much the cream of the crop. That's the one you want to be looking at. Over the long term, these trends are likely to show the economy and stocks in tandem. So what I mean by that is, as the stocks progress, the economy is also likely to progress. However, there's some differentiating factors where you might be in certain market cycles where stocks do not actually correlate with the growth of the economy, but rather they might be inverse. But this is something that we look at in the videos to come. In terms of day-to-day trading, this might be very hard to actually realize and see because these correlations are very long-term. And that's the thing with asset class correlations. We have to compare all the assets over time. It's not something that we see day to day. Oh, okay, I'm seeing DXY going up. I can expect the S&P 500 to go up as well. No, it doesn't work like that. It's something that we see fundamentally. And as you know, fundamentals are generally long term. You don't really get these, particular correlations on a day-to-day basis for your 1-minute charts or your 5-minute charts. So before we get into the rest, stock exchanges, you got the main types. You got NYSE, which is in New York. You got the NASDAQ and the CBOE in Chicago. I'd recommend, if you want to learn more about it, just do a bit more research as well. You can search up on YouTube or on the internet on Investopedia. And then some useful instruments to look at. Of course, we've explained the S&P 500. And then the Dow Jones is known as a DJIA. And of course, you've got the NASDAQ Composite Index. So anyways, guys, this was an introduction into the asset classes. Remember to understand what they are And then of course we're going to get into how they correlate and how we can use that to our benefit in a way. So anyways, guys, take care, and I'll see you in the next video.